Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, coming up on today's program, the passing of an investing legend. Also coming up, he who stands for nothing will fall for anything. The importance of having an investment philosophy. And we're going to share that with you on today's show. If you'd like to join us to talk about anything on your mind, a specific stock, mutual fund, ETF, or investment strategy, 844-305-7800 is the number. You can also tweet the program live at Index Show is where you find us on Twitter. So talking about the investing legend that passed away this past week, John Bogle died. He was one of the most remarkable and relentless crusaders against Wall Street that I've ever seen. He was an especially loud critic of how the mutual fund industry overcharged investors for subpar market performance. He was a champion of buy and hold investing, with index funds being, of course, the principal savings vehicle. Commenting on Bogle's influence and his greatness, Warren Buffett said, "If a statue is ever erected to honor a person who's done the most for American investors, a hands-down choice should be John Bogle." So that's what's going on in financial news. Also taking a look at financial markets, we obviously are keeping you on top of that, and we've seen a tremendous reversal in stocks. Of course, the fourth quarter was horrific, but so far this year, it's been a very good year. Since the start of the brand new year, the total U.S. stock market, as tracked by the Vanguard Total Stock Market ETFs, ticker symbol VTI, has gained just over 7%, and we see bonds lagging. Bond market pretty much flat, ticker symbol BND, tracks the total U.S. bond market down 8 basis points or 0.08%. Other equity markets are also rising. We've got developed international stocks up 6.5%, and emerging markets up about the same. ETFs tracking those areas, EEM and VEA. So taking a look at some other key asset classes, REITs globally are up just over 6.5%. That's another area that's doing very well. And look at this. Commodities are up 3.2% since the start of the year. It's been so far a good year for commodities. Over the past several months, we've seen a trickling up of prices in precious metals. So gold, silver, platinum, and palladium have all been strong performers. They did very well during the fourth quarter sell-off in stocks. As stocks were sliding, precious metals, led by gold, were gaining. And so that particular area, of course, has within the commodities group has been quite good. So that's your big picture view of financial markets. We look at this on a broadly diversified basis. We're going to talk a little bit later, though, about what's going on underneath the market, what industry sectors are driving market prices, and give you an update there. There's also been some new ETFs launched that amplify the performance of the brand new industry sector known as communications within the S&P 500. Now, you'll recall last year we reported that there was a change in the S&P 500, in addition of the communication services sector. And if I'm opening, and we're looking at our app from Select Sector Spider ETFs. It's available at the App Store, Apple's App Store. And if you open up your app, you'll see 10 sector ETFs. Now, one of those sectors, and like I said, the brand new one, and this is brand new because it was just introduced last year, is the communication services sector. So we're going to talk a little bit more in depth about this particular area, which stocks are in it, and a couple of new ETFs that amplify performance to that particular industry. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. We're here every week at this same hour, talking the birds and the bees of successful investing. I asked it earlier, and I'll ask it again. What is your investment philosophy? Do you even have an investment philosophy? And so on today's program, I'm going to explain to you why it's so crucial to have a philosophy that is rigid, that's robust, that's credible, and that's executable. And then also some of the things that we stand for on this show. And I'm going to share that with you so that you can make our philosophy your philosophy. In other words, adopt what we believe in your own investment strategies, in your own philosophy. Because I believe that the philosophy this program stands for, financially speaking and investing-wise, is the right philosophy. In other words, I've got a bias. Can you believe that? I've got a bias. Like that's an evil thing. I once had a financial advisor lecture me that his competitive advantage over other advisors was that he was a fiduciary and that he provided people with unbiased advice. And he really emphasized that. He said, I offer unbiased advice. That's what separates me from everybody else. And I was awestruck at the time by his charming confidence, but deep down inside I knew something was amiss. Something was wrong. I was especially bothered by that emphasis on unbiased advice. Although he found it to be uniquely different in his business, I did not. It's best practice for financial advisors to reveal the benefits and drawbacks of an investment or a strategy when rendering advice. I mean, that's a given. There's nothing special or exceptional about rendering investment advice the way it should be rendered. I found his claim, though, of being unbiased in all the investment opinions that he was giving, I found that to be wholly untrue. Everyone has a bias, especially he who screams the loudest that he doesn't have one. Whether we acknowledge it or not, we are all influenced by things. Life experience, people we respect, other events that happen in life or that come across our lives that steer and skew our opinions. This is an inescapable truth that applies equally to all people, including financial professionals, and especially those who erroneously claim not to have a bias. But the bigger point that I'm trying to make here, and I don't want to distract you, is that it's important to have a bias, I believe, but the right bias. And one definition of, just to contrast this, the word unbiased is to show no prejudice for or against something. It's to be impartial. And so I'm trying to contrast this with bias because I think it is okay to be biased. We all are biased. We all have a bias. The important thing here, though, is to have the right bias. That's the key element that I'm trying to convey to you. And that's what the philosophy is all about, having the right investment philosophy. So in the next segments on today's program, we're going to talk about having a philosophical investment framework that will help you to get ahead. And I'm going to explain to you what some of these philosophies are and what the elements of them should be and how you can adopt them. Also coming up, we're going to give you a recap of what's happening in some of the key industry sectors that underlie the stock market and tell you what's happening there. If you'd like to join us to talk about a particular stock, mutual fund, ETF, or strategy, we're here. 844-305-7800. As I indicated earlier, the passing of a financial legend, John Bogle, this past week, founder of the Vanguard Group, pioneer in the mutual fund industry. He grew one of the world's largest index funds from $11 million to over $400 billion. What an absolutely incredible feat. We'll be right back after this short break. Go nowhere!
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show. You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
In case you missed it on last week's program, we talked about the differences between fragile and anti-fragile investing, and that was a great episode. If you missed it, you missed a lot. But the good news is we've archived that program. It's available on our podcast. You can go to indexshow.com or pick up the show at Spotify, Apple iTunes, Google Play, as well as YouTube. Now, I want to give you a quick report and recap on what's happening in industry sectors within the overall stock market. And this will give you an idea. We talk a lot about indicators, market sentiment, market mood. The number one factor influencing stock prices, as I've repeatedly told you, is not PE ratios, it's not dividends, dividend yields, it's not fancy, neatly calculated statistics spewed out by Wall Street's analysts. It's none of that. The single most important factor that shapes stock prices is market psychology and the psychology of the participants that are investing in the market. And who are the participants? It's humans. And so it's the psychology, good or bad, positive or negative, that drives those prices. And if we take a look at all of the key industry sectors within the S&P 500, there's 10. All of them since the start of the year are up, and not just up, but up sharply. Now, the top performing industry sectors so far this year, and some of them were quite beleaguered last year. One that comes to the top of my mind is the energy sector, which got absolutely slaughtered. Of course, we saw crude oil prices, energy prices sliding in a big way last year. Well, it's been all up in 2019. The energy sector, ticker symbol XLE, the best performing industry within the S&P 500. XLE tracks that group. It's ahead by just over 11%. Other top performing industry sectors, XLF, tracking financial and banking stocks, ahead by just over 9%. That's a top performer. And then XLC, which tracks the communication services sector, up almost 9%. Now, I want to focus on this one because I mentioned it in the previous segment. This particular industry sector, I'm opening up my Select Sector Spider app on my mobile device, and it neatly arranges all of the key industry sectors within the S&P 500 and the ETFs tracking them. There's 10. So XLC is the ticker symbol of the ETF that tracks the communication services sector. And just to give you some background about what this industry group represents, the ETF XLC is designed to reflect modern communication activities and information delivery mechanisms. Industries include telecommunications, media, wireless, entertainment, and internet media communication companies, as well as components. So let's talk about the top holdings within this particular fund. There are currently a total of, how many holdings are in here? 26 stocks within this ETF. And so who are some of the top holdings? Well, you've got companies like Facebook, Alphabet, Netflix, AT&T. Those are the top 5 holdings. The Alphabet, by the way, has two share classes, A and C. So each of those are represented within XLC. Then you've got other companies like Activision Blizzard, Verizon Communications, Comcast, Walt Disney, Twitter, Charter Communications. So these are the companies that make up XLC, the communication services sector. This is, previously some of these companies were in different sectors. They were reclassified. So they were extracted out of other sectors that they were previously in. For example, telecommunications. Some of these companies were inside the technology ETF. But they were removed and they were placed and reclassified in this brand new sector to better represent what's really going on, the trends in terms of modern communications, in terms of business, in terms of how we get information. So this particular industry sector, like I said, is among the top performers thus far in 2019. And there's 26 stocks within XLC. When you buy XLC, you pay a small fee to own that fund. It's 0.13%, 13 basis points is the fee. And taking a look at some of the other ETFs that track this sector, Direction Investments launched a couple of new leverage and inverse ETFs linked to this particular sector. You've got ticker symbol TAWK. That's the Direction Daily Communication Services Bull 3X share. So this particular ETF aims for triple daily performance to this same sector. So if you're bullish on this sector, this is the fund to own, TAWK. And then the opposite of that, if you're a bear, the ticker symbol MUTE, mute. That's a good one. That's kind of a hard ticker symbol to forget. Mute. MUTE. This one aims for triple daily opposite performance to this same sector. So you can express your view bullishly or bearishly on this particular industry sector. I could tell you right now, the trend, at least in the short run, is bullish, very strongly so, and that's what we're seeing. So those are a couple new ETFs that track this sector. Again, that is the communication services industry within the S&P 500. 844-305-7800 is the number. We're here if you'd like to join us. What is on your mind, and how are you doing thus far in 2019? We told you earlier what the broader market indexes are doing. We also told you about the passing of an investing legend, John Bogle. One of my favorite quotes that he had, and of course there's so many quotable things that John Bogle said and did, but he had this to say: if the data do not prove that indexing wins, well, the data are wrong. That was one of my favorite quotes from Bogle, and he's right. He's right. The data does prove indexing is the absolutely winning strategy for all investors. Moreover, anyone that tries to disprove that with other data, showing that data or that fact of indexing being superior, if they try to counter that with their data or what they invent or something they come up with, it's not going to be true, because the data is wrong. The data is wrong that counters this argument. So indexing does win over the long run, and anything that counters that, data-wise or philosophically wise, is absolutely wrong. And that's why we also tell you, and this is one of the chief philosophies of this program, is that your core or the foundation of your portfolio should be indexed to the market. So we do make allowance for your non-core portfolio and your margin of safety to be invested differently. But what we don't make any flexibility on, and where we don't make any allowances on, is the fact that your core, the foundation of your portfolio, must be indexed. And so there you go. There's a philosophy that you can adopt in your own investment strategy. So it's very simple. Let's not complicate this, people. If indexing is the superior way to invest, if it's a strategy that outperforms the vast majority of Wall Street stock pickers and money managers and traders, we know that's true, well then it should absolutely be the core or the foundation of your portfolio. I mean, there's no exceptions to that rule. And so that's where this philosophy, I've just given you one piece of the bigger picture philosophy. There's many aspects of the philosophy, but that's an important one, is making indexing and index ETFs the core or the foundation of your investment portfolio. When we come back, we're going to give you more pieces and bits to help you with your own investing philosophy. I'll be right back.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
The way we access information and communicate has evolved. This evolution has resulted in the integration of telecommunication, media, and internet companies. The Communication Services Sector SPDR ETF offers access to the entire communication services sector while reducing single stock exposure. The Communication Services Sector SPDR, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
So the ETF industry would not exist and be what it is today without John Bogle. He single-handedly sparked a revolution. I call it the indexing revolution. And he helped people to really understand how difficult it is to outperform the broader and diversified stock market. Now, as much as I agree with most of the points and most of the philosophies of John Bogle, I did have some disagreements with him, particularly on his views of ETFs. He expressed many anti-ETF views, which I completely reject. Last year in Barron's Magazine, I wrote a piece talking about that on Seeking Alpha. That piece is titled John Bogle's Bastardized View of ETFs. And in that piece, I attacked Bogle's, what I believe his naive view, that ETFs seduce investors to hypertrade. That is, of course, something that he constantly said in his attacks against ETFs, that ETFs convince and seduce people to hypertrade. And my answer to that is, well, ETFs don't seduce investors to trade any more than cars trick people into crashing, or fire burning people, or water making people drown. I mean, it's an irrational argument. ETFs are a tool and a vehicle, and if someone's going to abuse the tool, if someone's going to use it incorrectly, it's not the tool's fault. It's the fault of the user. And that's just something that he never was really able to wrap his head around in all of his anti-ETF arguments. And I did an interview with him, a face-to-face interview. It's on my YouTube channel, actually ETF Guide's YouTube channel. And I'll throw up a link to that on our Twitter feed. But, you know, it was nevertheless, despite these differences, wonderful to spar with an investing legend. And I did spar with him. He wrote a counterpiece to my piece on ETFs. So it was good. It was a healthy debate. There was always mutual respect there, although that we did have our differences on ETFs. And I do believe ETFs, and I know this for a fact, that the data supports it, that ETFs are a superior investment structure to mutual funds. I know that factually. I know that he had affection for mutual funds, especially the index fund and the S&P 500 index fund that he launched at Vanguard. I know that. And it's your baby. It was his baby for so many years to defend that fund. And at the same time, though, when the new structure came along, the ETF in the early 90s, and began to show itself as sort of a competitor to the mutual fund structure, a superior competitor in many ways, offering investors greater flexibility, intraday liquidity, which again Bogle demonized. Why do investors need intraday liquidity? Well, quit demonizing it. It's giving investors flexibility. It's giving them a choice. That's something we should be supporting, not demonizing, rather than tying up their money until the end of the day after the market closes. But again, these were the differences that we had. But the point is that the philosophy on indexing was right on. And that's something that we both agreed on. But nevertheless, I'll send up a link on our Twitter feed. You can watch that video, that interview that I did with Bogle. And also, I need to dig around in the archives. He was on this very program many times, and I'll have to search for some of those old interviews. And once we find them, we'll be sure to post them as a tribute to a great and legendary investor. 844-305-7800 is the number. You're listening to the Index Investing Show. I'm your host, Ron DeLegge. I am also the inventor and the founder of the Portfolio Report Card. It's a one-page report that's designed to tell you the strengths and the weaknesses of your investments. And it does that in 5 key categories: cost, risk, diversification, taxes, and performance. The wonderful part about the Portfolio Report Card is that it's a multidimensional report. Many reports out there, or systems or software, will attempt to tell you about your portfolio in just one area. For example, risk. There are software systems that sell for thousands of dollars that financial advisors and financial professionals subscribe to that just tells them about one thing within the portfolio: risk. And that's okay, but it's just a one-dimensional view of the portfolio. What about the cost of the portfolio? What about the tax efficiency of the portfolio? What about the diversification of the portfolio? What about the performance of the portfolio? If we're going to pay thousands and thousands of dollars to some software company to tell us about one aspect of the portfolio, that's a pretty incomplete way of looking at a portfolio. So the great part about Ron DeLegge's Portfolio Report Card is it takes a look at the entire picture, a 360-degree view of your investments. And it took me years to develop it, and years to refine it, and also years to just even arrive at something so robust. And so anyway, it's a tool that I think can help you to really make sure that you're on the path that you should be towards your financial goals. So if you'd like to get a free analysis and have a look at what really is going on with your investments, all you got to do is go to portfolioreportcard.com. The monthly issue of ETF Guide Premium has been released, and we're not going to have much time to share much in the way of tidbits with you of what the February issue contains. But I do want to just mention real quick that the February ETF income trade was just executed, and of course that's mentioned every single monthly issue of ETF Guide Premium. The latest trade involves selling some covered calls on ticker symbol GLD, that's the gold ETF, and ticker symbol SPY, which tracks the S&P 500. And so the exact moves, well, you'll need to be a premium member to know what they are. But this particular income trade for February generated just over $1,100 of monthly income. So this is another excellent way to add to the kitty. Those of you that are income investors, retired, looking for more money, and this goes back to the superiority of the ETF vehicle versus a mutual fund vehicle, is that ETFs, at least the large ones, have underlying put and call options. And that allows you, depending on your strategy, to generate more income. In this case, if we're selling covered calls, over and above what you're getting paid on dividends from your ETFs, right? We can also get money by selling covered calls. In other words, we're giving other investors the right to buy our shares at a certain price in the future. And so this is another strategy that you cannot do with traditional mutual funds that you can do with ETFs. You can also protect your positions. For example, last quarter, many portfolios were sinking like the Titanic, and instead of just sitting there and watching that happen, watching your money melt away, the ETF investor that wants to be actively protecting their money has a couple of choices. Well, one of those choices, we talked about the inverse ETFs that allow you to grow and protect your money when market prices decline. Well, if you don't want to do that, you can also buy put options on your ETF portfolio. If the ETF portfolio goes down in value, the put options are designed to increase in value, thereby offsetting any of those declines. So put options, think of it as insurance, right? When you have a loss of your home or a loss of your car or a loss of another object and it's insured, what does the insurance company do? They hedge you. They offset that loss through your insurance protection. It's the same with put options. So anyway, these are some things that we're bringing to your attention. The ETF Guide Premium issue of February is out. Go to etfguide.com and become a premium member. 844-305-7800 is the number. You're listening to the Index Investing Show. We're here. What is going on with your investment portfolio? Are you on track to reach your financial goals? Do you need help with a particular stock, mutual fund, ETF? Do you want an opinion? Do you want me to analyze it and break it down? I can do that. Again, 844-305-7800 is the number. You can also tweet the program at Index Show. And when we come back, we're going to finish off this discussion of having an investment philosophy, why that is such an important thing. And we're going to give you some things that will help you to, that you can adopt in your own investment strategy. I'm Ron DeLegge. This is the Index Investing Show, and we'll be right back.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show. You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Okay, there was another new ETF launch. Direction Investments introduced its first ever relative weight ETFs. And there are 10 of them. And these particular ETFs offer exposure on indexes from FTSE Russell as well as MSCI. They're tracking a whole bunch of different investing sectors from defensives to cyclicals. You've also got developed markets as well as emerging markets. And then there's a couple that play on growth and value as well as large cap and small cap. So these particular ETFs, I'm going to send a link on this on our Twitter feed. And in a couple of weeks, we're going to have Sylvia Jablonski from Direction Investments on the program. We're going to talk a little bit more about what makes these particular ETFs different than previous iterations. Now, on next week's program, Dan Dolan will be our program guest. We'll be talking about sector investing strategies and the benefits of sector ETFs over individual stocks. And so be sure to tune in for that. We always have a good time when we talk with Dan, and he gives us the very latest on the investing trends with sector ETFs. So stay tuned for that. If you'd like to join us, 844-305-7800. We're here. If you'd like to tweet the program, you can do that at Index Show. Some of the things on our Twitter feed from this past week, we got a relink here of our podcast from last week, Anti-Fragile versus Fragile Investing. Also, a relink by a guy by the name of Northman Trader. He said, you want to know why the Fed never predicts a recession? To do so would accelerate its arrival. Investors would sell stocks, markets would tumble, and confidence would be shaken. The Fed is in the projecting confidence business. Bernanke projected confidence with subprime mortgages. He said they were contained. And Powell says that there's no risk of a recession. I think that's a valid point. That's why the Fed never predicts a recession. It was just like, Paul Samuelson, the great economist, the Nobel Prize winner in economics. I forgot the year. But the Fed is really an institution made up of economists. And Paul Samuelson so correctly said many years ago that that Wall Street's economists accurately predicted 9 out of the past 5 recessions. So think about that. They predicted 9 out of the past 5 recessions. That's how accurate they've been, which is not very accurate. So anyway, these are things that are on our Twitter feed at Index Show. Let's talk about investment philosophy and why it's so important to have one. He who stands for nothing will fall for anything. If you don't have an investment philosophy, you're a sitting duck. You're going to be victimized by something that is probably the wrong philosophy, or not having any philosophy at all is not going to keep you very grounded, especially when markets go haywire. So for an investment philosophy to have any iota of credibility, any iota of legitimacy, it must first have all of the following characteristics. It must be proven. It must be deliberate. It must be actionable. It must be repeatable. It must be realistic. It must be reliable. And it must be complete. So those are some of the things, the characteristics that an investment philosophy, for it to have any iota of credibility, it has to have all those characteristics. Every single one of them. Not one of 6 or 1 of 7 or 2 of 7. It has to be all of them. So I don't really have time to get into each one of these particular characteristics or aspects, but what I do have time to get into is to discuss the framework, the philosophy. So we already kind of discussed this a little bit earlier, that your portfolio or the foundation of your investments, and what do I mean by when I say foundation? I'm talking 51% or more of your investable assets. So whatever your portfolio total is, if it's $1 million, if it's $2 million, if it's $10,000, I don't care what that number is, but what you need to understand is that for your core, the foundation of your portfolio, 51% of that money or more needs to be spread across the 4 major asset classes: stocks, bonds, commodities, and real estate, using broadly diversified index ETFs, which serve as proxies for each of these groups. So that's your core. That's your foundation. Now, what happens if your core suddenly goes from 51% to 49%? Well, then guess what happens? It's not your core anymore. It's not your foundation. If we're building investment portfolios where the core is less than 51%, what happens if you build a house, a structure? Let's just take, for example, a skyscraper that has a weak foundation, that doesn't have a strong footing. That structure is going to topple. Now, it may not topple when the sun is shining, when the birds are chirping, but when it starts hailing cannonballs from the heavens, when it starts storming, when the wind starts a-blowing, you're going to see that structure tumble because it was built on a weak foundation. The same concept, the same idea applies to your investments. So the core portfolio is spread across the 4 major asset classes that I just described: stocks, bonds, commodities, and real estate, using broadly diversified index ETFs. That's your core. That's your foundation. Now, the core portfolio is complemented by other containers within your overall investments. You've got the non-core portfolio, which is the only correct place to hold non-core assets, including but not limited to individual stocks and individual bonds, derivatives like puts and call options, inverse and leveraged ETFs, actively managed funds, hedge funds, private equity, cryptocurrencies, venture capital. These are all non-core asset classes that the only proper context for these types of investments inside a portfolio, philosophically, is within a non-core portfolio. That's a much smaller portion of your investments compared to your core. If the core represents 51%, your non-core clearly represents a much smaller portion of your overall pie. So that is the philosophy we want you to adopt. You've got your core portfolio, you've got your non-core, and then you've also got one more container, which we call the margin of safety. Now, this represents a portion of your investment portfolio that's earmarked for principal protection, zero volatility, and liquidity. Now, the other important aspect to remember about your margin of safety portfolio is that it's not designed to give you a high return. That's not the purpose of the margin of safety portion of your portfolio. The purpose is to give you stability. Also, all and any assets that are subject to market losses, including but not limited to AAA rated bonds, gold, U.S. Treasuries, do not qualify as margin of safety assets and therefore should be allocated elsewhere. This is a very important principle because sometimes investors make the mistake. It's a fundamental mistake. They say, well, I'm going to complement my stock portfolio. In case that goes down, I'm going to buy more bonds. Well, guess what? Bonds can and do lose value. Bonds are not guaranteed. And the same goes for gold. So those do not belong in your margin of safety portfolio. So this is the philosophy. This is the framework that we just described and that we just gave to you. And this will help you to have a rigid and robust investment strategy so that you can not just get ahead, but stay ahead. It's been great having you on our program and listening and tuning in. Be sure to join us again next week. Dan Dolan with Select Sector SPDRs Beyond the program. I'm out.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.